Okay, ladies and gentlemen, microphone check 1, 2. My name is Noel A. Booker Sr. I'm with Business Credit Builder. And what we do at Business Credit Builder is help entrepreneurs build their business credit and access funding. Okay, today we're going to be talking about what lenders look at to approve you for financing. We're going to go over some interesting stuff that you should know. Okay. Okay, here goes my contact information. Once again, my name is Noel A. Booker Sr. The website is businesscreditbuilder.us. Okay, my contact information is listed there. Got my email and my phone. Now we got 3 buttons there. Okay, the green button is how you can get a free guide on how to build business credit. Just go to businesscreditbuilder.us/free guide. And you can get your free guide on how to build business credit. Now, if you want to talk to us about how we can help you build your business credit, or if we can go over making a finance assessment of your business to see what you qualify for, you can schedule a free business credit consultation by going to /consult. All right. Now, if you think you qualify for funding now, just go to businesscreditbuilder.us/get funding. Okay. All right, let's go. Let's get started here. And before I get started, I just want to let you know one thing about when you're thinking about funding your business. All right. There are 3 C's of funding. The 3 C's of funding are credit, collateral, and cash flow. So these are the 3 things lenders are definitely going to look at to see if you qualify, right? They're definitely going to look at these things. Now, if you have all 3 of these things, you can possibly qualify for an SBA loan. An SBA loan is the best place you can get money for your bank, for your business. All right, because they give you a lot of money, low interest rates, and they spread that over time. Now, if you have 2 of the 3 C's, then you could possibly qualify for a term loan. If you have 1 of the 3 C's, depending on which one you do have, then there is funds available for your business. Now, if you have none of the 3 C's, then that's when you start with business credit. So now we're going to go over the things that lenders look at when they are determining whether or not to approve a loan. Okay? Okay, business financing. It could be a challenge, particularly for startup companies. Lenders tend to be cautious. They want to be sure you'll pay them back. That's understandable, right? Okay. Business lending. There are several options. These include traditional lenders, usually the commercial banks, right? Online lenders, micro lenders, and the SBA. What do loan applicants need to supply? This is good information to know. Lenders generally want to see that you have enough assets, sufficient financial reserves, and enough personal collateral to ride out business fluctuations. Okay, they want to know that you're stable. If something happens, you're able to adjust and keep moving, right? How do loan applicants demonstrate these things? Borrowers need to show a solid cash flow sufficient to repay the loan. They need to show a track record of profitability, and they have to demonstrate success in a similar business endeavor. Essentially, they have to prove their credit worthiness. This isn't easy when you're just starting out. Okay, how do borrowers prove their creditworthiness? For startup entrepreneurs in particular, they will need to demonstrate by using other means, and they are credit-worthy business owners. How do business owners prove their creditworthiness? One way is to prove they owned or managed a profitable business in a different industry. This means bringing in a resume and maybe financials from an earlier venture. They may be able to show this if they can supplement their own experience with that of someone who has already had success in the field. Okay, makes sense? This means bringing in a partner or maybe an angel investor as a mentor. Okay. One way to prove is that they own and manage profitable business. Okay, yeah, I did that. All right, preparing to meet with a lender. Okay. The borrower should have the following items: a sound business plan, any financial information they can provide on their business, information on their personal credit. Also, often also, some means of securing the loan. What goes into a sound traditional business plan? Okay. Industries vary, but traditional business plans all have similar components. Okay. So y'all can take notes on this. All right. We're going to go over what goes into a traditional business plan, and we're also going to go over what goes into a startup business plan. Okay. So y'all can take notes, follow along. Okay. Here we go. These are an executive. Okay, this is for the traditional business plan. They need an executive summary, a description of the company, okay? A market analysis, okay? The market analysis is, who are you going to? Who's your audience? What's their demographics? Who are these people? What do they do, right? Business plans also include data on the company's organization and management, a description of the service or product line, marketing and sales data. Startups don't have much in the way of sales data, but they should have a handle on how they're going to market their wares. Business plans also include a company's actual funding request, financial projections, an appendix which includes all supporting documentation. Startup business plans. These are usually shorter than traditional plans. They include information on key partnerships, activities, and resources, the value proposition, customer relationships, and segments, okay? They also include, for the startup business plans, communication channels. The communication channels is how you're going to be reaching out to your prospects. How do you communicate with your suppliers? Stuff like that. A cost structure, revenue streams, okay? Executive summary. Now, parts of a traditional business plan include an executive summary, okay? A brief overview of your company, product, executive team, and future plans for growth. Company description. Get all the detail about your company's niche and the problems it solves. And a market analysis. How can you do better than your competition? Company organization and management. What's your business entity and who does what? Service or product line. Not only what you sell, but also future plans or even patents. okay? Marketing and sales data. What are your strategies to attract and retain customers? Okay, they want to know the detail about that. How you go about that? How are you better than the competition, right? Okay, parts of a traditional business plan. The company's actual funding requests itemize and clearly show how you are looking to spend the funds. Financial projections, including income statement and the like if the company is already established. If not, it is the place to list potential collateral, okay? Stuff that you plan to get, okay? An appendix. Here's where to add licenses, permits, and patents, okay? In the appendix. Okay. Parts of a startup business plan. Here go the key parts. Key partnerships. Which suppliers and manufacturers will you work with? Key activities. How will your company gain a competitive advantage? Key resources. Which resources will you leverage to give your customers value? These can include personnel, intellectual property, and capital. Parts of a startup business plan. Value proposition. Which unique value will your product or service bring to the market? Customer relationships. What will the customer experience be like? In person, online, something else? See, I used to do a lot of events, special events, and I would always think of the customer's experience, how they found out about me, what did that look like when they found out about me, and then my call to action. How did I call them to action, and what their exact experiences would be once they did the call to action, right? And you want to follow that to the part where it comes to the sale, right? Okay. Customer segments. Who will your business serve? Do you have a good handle on what your ideal customer is like, right? No, in other words, they want you to know who your customer is, who your target market is, and how you're going to attract them. Parts of a startup business plan. Communication channels. How will you speak with your customers? How will you optimize communications in the future? Cost structure. Will you be trying to maximize value or reduce costs? Regardless of strategy, how much is going to cost you? Okay, how much is that going to cost? Revenue streams. How will your venture actually make money? Direct sales, membership, subscriptions, selling ad space, or something else? Financial information on a business. Apart from the business plan and its contents, you will need a P&L, okay? That's a profit and loss statement, okay? This is one of the basic financial statements a business needs to have on deck and ready to provide a lender. Once you submit an application, you should have all these financial documents already on hand and not go scrape it up and stuff, right? See, a fundable business has this stuff on hand, okay? Now, profit and loss statement. A P&L is, according to Investopedia, a financial statement that summarizes the revenues, costs, and expenses incurred during a specific period of time, usually a fiscal quarter year. These records provide information about a company's ability or lack thereof to generate profit by increasing revenue, reducing costs, or both. The P&L statement is also referred to as statement of profit and loss, income statement, statement of operations, statement of financial results, and the income and expense statement. Okay, and you can see online that there are a lot of examples of that, right? So an income statement at the top, it has the revenues, right? Total gross revenues, right? Then you have all your expenses. You take away your expenses from the revenue and you have your profit, right? And this is good information. Okay, so profit and loss statement. The P&L, one of the 3 quarterly and annual statements a company makes as to its financial health. Well, companies do this differently, right? Sometimes they do it, most of them do it monthly. Then some might just do it quarterly, but they definitely going to do it yearly, okay? The other 2 are the cash flow statement and the balance sheet, okay? There are numerous blank P&L forms online to help you. What does a P&L show? The idea is to show changes in accounts. This is over a specific time frame. In that way, it's similar to your cash flow statement, okay? This is not like a balance sheet, which is more of a snapshot, okay? So the P&L is used by the lenders to look at your financial condition and the trends, but you can gain much information as a business owner by studying your P&L over time, by looking at trends, right? Let me tell you a little quick story, right? So I had a corporate job, right, in accounting, right? And I'm responsible for their financial statements. So this company was pretty big though, right? So when I did their P&L, they had a column that was what was budgeted, right? So they know how much they're going to budget for a particular item, right? And then there's the actual, what they actually paid in that period. And then there's a column for the variance. The variance comes in a percentage, right? So if my variance was 10% or more or less, then I would have to explain that, right, to my boss, right? I would have to explain how come it was more than 10% of what we budgeted. And for me to find that out, I would have to go to the department manager and figure out why he coded these expenses here, or did not, his expenses that is supposed to be there was not there. Why not? You know, because they're supposed to spend their budgets, right? So, and you know, they look at this stuff and they strategize. When they see numbers going up or see numbers going down, they're strategizing, why is this happening? How can we get that profit number up, right? That's their bottom line. How to get that profit number up, which means reducing costs or increasing revenues or a combination of both. Okay, what does a P&L show? A P&L gives a handle on the money your business has. You know how much capital is coming in and going out. It's good for more than just yet another piece of paper to give a lender, okay? So you strategizing is even more valuable to you than the lender just looking at it. If you're studying it, right, you should know your numbers, right? Okay. Monthly and annual revenues. Online lenders in particular want this data. It shows not only what your company makes, but also any trends or even seasonality, okay? They're looking at all that. They're looking at all that stuff, considering why these months were low or these months were higher, right? Bank balances. Online and offline lenders want this data. It helps to show not only trends, but also responsibility and money management. It also, it's another way of showing seasonality, okay? The power of knowing your numbers. The power of knowing your numbers is vital to running any profitable business. You can make any necessary adjustments to show a profit. Numbers do not lie, okay? The numbers don't lie. That's why it's good to study these numbers, right? They tell everything about the health of a business. It's hot. Excuse me. Okay. All right. Okay, the power of knowing your numbers. Knowing your numbers means that you have a huge advantage over business owners who do not. Your profit and loss statement tells the story of your unique business. Okay. Understanding the story behind your numbers can be an extreme important factor for achieving success. Okay, personal credit information. Lenders often want to see your FICO score. This is particularly the case for sole proprietorships and startup companies. They want to know if you're experienced and paying back loans, or if you default on your obligations. That's what they want to know. Time and business information. For online lenders in particularly, time and business matters. Of course, a startup has no time in business, but other ventures do. Because so many businesses fail in their first year, creditors want to know this, okay? So they're looking at the time in business, okay? Means of securing the loan. Lenders are often looking for a means of securing the loan. This protects them in case you default on your obligations. Fortunately, collateral and other means of securing loans can be done creatively. Okay, so you have collateral-based loans, okay? Collateral-based loans use your assets as collateral. Rates are often 5% or less. Your personal credit rating will not even matter. They're just looking at the value of your collateral, right? Here goes some types of collateral you can use. You can use your 401k, stocks, existing inventory, accounts receivable, okay? Or ask a friend or family member with these kinds of assets. They may let you leverage their asset in exchange for a percentage of your business. Essentially, they will be acting like an angel investor. It's a bonus if they can mentor you in the business, right? 401k financing. Okay, here goes some details about the 401k financing. So with the 401k financing, you use existing 401k or an IRA as collateral for your business financing. Pay no tax penalties. You still earn interest on your 401k. There are low rates, often less than 5%. They close and fund in less than 3 weeks. Can usually get up to 100% of what's rollable within your 401k plan. Okay. Securities-based financing. Use your existing stocks as leverage to get business financing. Borrow as much as 90% of the value of your stocks. You keep earning interest on the stocks pledged as collateral. Closing and funding takes less than 3 weeks. Okay. Also about securities is you get 70, 90% loan to value. Rates are like mortgage rates. 5% is common, but you only pay interest on what you borrow. This is a working capital line of credit. So they give you a line of credit for this type of stuff, right? And challenge personal credit is okay. Inventory financing. So you can use your existing inventory as collateral for business financing, but they want to see that, it's organized correctly and you have an inventory process, right? They're going to want to know that type of stuff, right? You will need inventory valued at $300,000 or more. You can get approved for a line of credit for 50% of the inventory value. Rates are usually 5 to 15%, depending on the type of inventory. Okay. Funding within 3 weeks or less. Okay. Minimum inventory amount is $150,000 is what they will give you. General loan to value is about 50%. The inventory value needs to be $300,000 or more. It can't be lumped together. It can't be lumped together inventory like office equipment, right? Okay. Accounts receivable financing. Use your outstanding account receivables for financing, such as 80% of your receivables advance ongoing in less than 24 hours. Remainder of the accounts receivable is released upon the invoice is paid in full. Closing takes about 2 weeks or less. Okay, so this one is pretty popular, where you have your invoices that you are waiting to be paid for. You can just sell them, right, and get paid on those. Okay, all right. Factor rates are as low as 1.33%. Is a credit line with rates of less than 1% with no consumer credit required. Receivables should be with the government or a credible business. If you also have purchase orders, you can get financing to have those filled as well. So businesses that have government contracts, right? Road repairs and, building bridges and those type of businesses that are doing municipality contracts, those type of promises to pay upon completion of a service, you can get business loans for, okay? Not at the commercial bank, but there are alternative lenders that will provide funding, right? So for instance, let's say you're a construction company and you got this contract to do something, right? But you need this piece of equipment to do it. So you go into these type of lenders and you say, hey, I got this government contract. I need to get this piece of equipment. And they're going to hook you up. That one's a simple one right there. You see? Okay, let's continue. You won't need to use any cash flow to do it either. Okay, so get forwarded up to 80% of receivables. You have to be in business for 1 year. You must be receivables from another business. Rates of 1.25 to 5%. Okay. Other collateral options. Okay. Other collateral options include your company's equipment. You can also use invoice factoring. Invoice factoring is not quite like a loan. Instead, you essentially sell your outstanding invoices to a factoring company. They will collect it. They will collect directly from your customers. Okay, that's how I started with business credit. I was with a freight company, right, and they were using factoring to fund their business because they had the trucks, right. The trucks will go make a delivery, then they're invoiced to make that delivery, right? But then they wouldn't get paid for 30 days, but they needed that money now to pay their drivers and to pay the notes on the trucks, right? So that's how they funded it. They got the factoring. They get the money in 24 hours, okay? Okay, personal guarantees. Another option is the personal guarantee. It's exactly what it sounds like. Your personal assets are at stake, but sometimes, particularly for startups, you'll have to give one. Okay, microloans. Microloans are another option. You can't get a microloan from a regular lender. Instead, you get a microloan from a micro lender. Try the Association for Enterprise Opportunity to find a local micro lender. Go to microenterpriseworks.org. Got it? All right. Yeah. The SBA. Now, this is the best place to get money for your business, all right? But most of us don't qualify. okay? But the SBA loans are another option. You usually need to show some time in business for SBA loans. The most popular SBA loan for working capital is the 7A. Approvals up to $750,000. Rates are usually 2 to 4% above prime rate. All owners with more than 20% ownership must provide a personal guarantee. Good consumer credit is required. Actually, excellent consumer credit and excellent business credit is required. Okay, here's a recap before we get out of here. Recap for what lenders look at to approve you for finance. Lenders want to be sure a company can pay back its obligations. They want to know your business is a going concern. They want to see if it is succeeding or if it should be. Borrowers need to prove their credit worthiness. Documentation is crucial. Virtually every lender wants to see a business plan. Business plans can be traditional or for startups, and these have different sections. Lenders also want a P&L. Okay, the P&L, they also going to want that cash flow analysis and the balance sheet. They usually also want some sort of collateral or personal guarantee. Okay, so I want to thank everybody for coming. You can find more information on my blog. It's at businesscreditbuilder.us/blog. The name of the blog is called Business Credit is Real. And please check out the social medias. We even got a Spotify channel. The podcast is on the on our Spotify. The podcast is called Business Credit is Real. Don't forget to get your free guide on how to build business credit by going to businesscreditbuilder.us/free guide. You get your free business credit consultation, which means you talk to us about how we can help you build your business credit and prepare you to qualify for loans. If you think you qualify now, click the red button and go to /get funding. All right. Don't forget my ebooks, right? So I got ebooks as low as $10. Just go to businesscreditbuilder.us/ebooks. Right? And don't forget, schedule your free business credit consultation. Start now. Building up your business credit. Get qualified. Prepare. Right? All right. Everybody, thank y'all for coming. Here goes my contact information once again. Feel free to schedule your business credit consultation, and let's get going. Let's get the business popping for the 2023, right? All right, everybody. Thanks for attending. And have a good day. Take care. Let's see how we get out of here. Let's see. Let's get out of here. All right. Boom. All right, everybody. Take care.